Some banks have been paying dividend for over 100 years. That makes the love of all investors. But are they equal? Should you have them all? And are there better banks than others? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique, and today we are tackling one of my favorite topic, Canadian banks. How are you doing, Vero?
I'm doing good, Mike. And you know what? I still feel that the 2008 financial crisis has left some investors traumatized about banks, especially on the US. However, Canadian banks make an excellent investment for investors on both sides of the border. But that said, they are not created equal. Let us share our ranking today.
Yeah, they are definitely part of the best banking system in the world. And the key here is regulation. We're going to talk about that in a second. But really, it's not necessarily bad because we have the best managers, but because the federal regulations are so tight that banks are just forced to stay alive and be well. In fact, when you compare banks to a body, it is like the heart pumping the blood throughout the entire body. If banks stop having liquidity, stop having to be able to exchange cash like lending and receiving deposits, the entire capital system crumbles within seconds. We always fear that a bank run could happen. So having heavily regulated banks also improve the confidence that we have in our system. And that made a handful of great investment opportunities.
Small disclaimer before we start. Remember never to consider the stocks mentioned on this show as buy or sell recommendations. Always do your due diligence. Okay, Mike, first explain how the oligopoly in which Canadian banks find themselves benefits them.
Well, first, which is great, is you have less competition, right? You're a few numbers of great banks, well established. So kind of like everybody could have like a piece of the pie and eat and not starve. So that's a great thing. The other great thing is having a lot of regulation, as I said in my intro, also prevent banks from making massive mistakes. I remember in 2008, during that time, well, before the crisis, I mean, a lot of investors thought, well, Canadian banks are boring. Canadian banks don't take enough risk. Canadian banks don't grow fast enough. Well, it was all true if you compare them to big European and US banks that were heavy on investment banking, creating like all kind of products, and we know how it ended up, right? The reason why Canadian banks did not fall into those subprime mortgages and all of those products that were packaged based on this toxic product was actually because they were not allowed to do it. They were not allowed to lend 125% of the value of the house to the consumer and then repackage that subprime mortgage and then sell it as a credit option. All of that was impossible to do for them. So it's a good thing to have that oligopoly. Finally, in time of heavy crisis, and we saw that during COVID, the government will come to the rescue every single time. So it's a lot different than the banking system in the US where you have like different bank every corner. So it's like they are like Starbucks over there. I think it was like there were thousands of different banks. So in Canada, they cannot really let any of the six major players down because if one goes down, the entire system and the entire trust in the system, as I explained before, will tumble very quickly. So it's kind of like another layer of protection that goes both ways for investors, for consumers, and also for banks as well. So that's why banks today have been able to get out of the 2008 crisis with a very similar business model for all of them. I mean, they're all offering personal and commercial credit, savings, and loans, and all of that. But after 2008, each of them took a different route to grow. And this is what we're going to talk about today in the ranking is more to talk about what's the different angle because at the base they're all the same, but the more you dig, the more you realize there are completely six different business model here.
Historically, Canadian banks have outperformed the market for a couple of decades now, but recent years seem to have highlighted some of the flaws of Canadian banks. So, how has the context evolved to explain that?
Yeah, a few years ago, it was crazy because banks were actually even outperforming the S&P 500. It's not true anymore today, but after the financial crisis for a long while, they were just the perfect balance between a good yield, like most of them offer a yield around 4%, and a decent growth perspective. Over the past few years though, it has changed drastically for a lot of reasons. First, between 21 and 24, we had higher interest rates, meaning it doubled with higher inflation, and that led banks in 22 and 23 more specifically to increase their provision for credit losses by a lot. A lot of banks decided to go more conservative, and this is a classic playbook for them. It's kind of like managing expectations. So you put the bar so low and you tell the market, oh, we're taking so much provision for potential credit losses that a year or 2 years later, you can recover some of those PCLs. And the PCLs will affect earnings. So you're just saying, hey, my earnings are super low right now because we fear consumers will not pay off their debt. And then we're going to have to write those debt off our books and take the loss. And in the end, a portion of that is actually recovered, which transform into earnings later on. So that was the first thing that happened. A lot of investors started to get concerned about the potential recession, having consumers getting strapped with their debt. And then we got more bad news for specific business models. So we had big anti-money laundering
Mhm.
issue with TD that concluded last year at the end of last year with a FD fine. I think it was like 4 billion or something. So like pretty expensive fine, more regulatory scrutiny. So having people in the US tracking down TD to make sure that they improve their process, they track down how they treat transactions. So it's going to slow down their activities in the US. Of course, it's going to increase the cost of doing those activities because you must add more people, longer and better processes. And finally, they are capped to grow their business in the US in terms of like their assets level is capped. So a lot of bad news for TD. Recently, we got BMO at the beginning of 24 with a higher PCLs. Even the last quarter, they reported a little bit more than a month ago. The provision for credit losses kept on increasing like there's no tomorrow. Fortunately for BMO and for investors, other segments were doing better, but still very tough on what's going to come up next. It's really a game of how good you assess your loan portfolio and your potential losses. And right now, I think it's a pretty good timing to review our ranking to adjust based on what just happened in the past few years.
All right, so let's start that ranking at number six. The bank we dislike, unfortunately, the most among the big six is Scotiabank, BNS. What's the investment thesis for BNS, Mike?
Before we start, I've been I don't know, can I say PNS hater? No, I don't hate any banks, but like not a cheerleader for sure. For like
For sure.
15 years. Yeah, for a good 15 years. So, we're not going to talk too much about like the classic activities, but more about what is the distinction between one or the other. So, the key
Mhm.
characteristic that will make a big difference. So, first, Scotiabank, third largest bank by assets in Canada, behind TD and Royal Bank. So, definitely a big player. Made interesting acquisitions throughout the years with MD Financial and Jerry Slosky Fraser, making them also the third largest wealth management company in Canada. So, very solid base here, but here's the kicker. Great story about international exposure. About 40% of their revenue are coming from Latin America. Their economy is supposed to grow faster than North American countries like US and
Right.
Canada. They recently sold some of their activities in Colombia, Costa Rica, and Panama to make it probably like a leaner business model, a little bit more cleaner. So there are a lot of like hope and potential towards those moves to have something a little bit more centric. And yeah,
So, Mike, I'm sure your answer to my next question will explain the first one, and it is what makes it lag behind its peers?
yeah, I was waiting for that. Okay, more seriously, I keep talking about the difference between the story, the narrative, the investment thesis versus the numbers. So
Right.
the international exposure actually brings a lot more volatility than it brings growth. In other words, it's a seductive story, but it's not generating more profit. So that is the main reason why Scotiabank is not able to grow as fast as other banks. It also announced no dividend increase in 24. We're still waiting to see what's going to come up next in 25. But keep in mind, no dividend increase is a form of passive dividend cut because there was inflation between last year and this year. And Scotiabank did not met its ends of the bargain. So just keeping the dividend as is, not enough in my opinion, especially while
Mhm.
all the others are able to increase it. They're all also the one that is showing the highest payout ratio among the six. It's not alarming. I don't think they're going to cut their dividends, so I don't go crazy. But still, not necessarily another point of being enthusiastic for this bank. So maybe you want to make a short term play on the recovery path, but I prefer to have like a very long term vision because the comeback, yes, maybe Scotiabank is going to outperform National Bank for 3 months. Kudos to you if you did the move, but really, I'm really thinking about the next 10, 20, 30 years. And this is where I'm not seeing Scotiabank right now being able to compete against other banks. That's why it's number six.
All right, Mike, I'm just tempted to add a question here. Quick question. Let's pretend I'm a BNS shareholder. Is it to the point that I should sell my shares of BNS and buy another better Canadian banks instead?
Here's how I see it. If you have $10,000 invested in Scotiabank, do you think it's the best $10,000 invested in this one? Like, do you think that maybe you could use that $10,000 to put it in another bank that shows stronger metrics? Because
Mhm.
again, if you just look at all the metrics in the world, they're pretty much dead last on all of them. So do you really want to keep this one, or do you want to just transfer your capital into a bank that has better perspective and better numbers? I'm
Mhm.
going to leave it that at this point.
Okay, at number five, we find CIBC CM, which shows a strong focus on domestic retail and commercial banking, right?
Yes, and it paid well actually in 24. CIBC did incredibly well. I think it was like the best performing bank or the best performing one. Definitely a good ride for them. So quite surprising
Mhm.
and kudos to CIBC. It is the fifth largest bank by asset. And I even made a joke at one point with National Bank as it was trading close to its all-time high. I'm like, you know what? Maybe like in 5, 10 years, it's not going to be the smallest bank anymore, and CIBC is going to become the smallest one. Of course, more a joke than anything else. But anyway, just to show you where it sits in terms of the banking industry. It left the US market after the financial crisis, and that was quite painful. They decided to come back around 2016. They made more acquisition there. It was not a big success sometimes. These days, a lot better, which explains actually that in 24, the CIBC did better. But overall, I would say it is one of like the most classic bank in sense of like they focus on just like the personal and commercial banking. They have that focus on retail. Yes, they do wealth management and capital markets, but they are really just like a savings and loan classic bank that you can find.
So, what are the reasons to dislike it?
Well, I see like less growth potential due to that classic
Mhm.
business model first. The second thing is it's more exposed to the Canadian economy for that reason. And they also have the highest concentration of uninsured Canadian mortgage compared to its peers. So all of those combined together, I mean, again, if you invest in any of the big six, you're probably not going to lose your house if you do that. It's not like a bad investment. But we
Mhm.
have to rank them. And I think that position 4 to 1 is a lot stronger than CIBC. But again, I don't dislike the bank. It's just that we have better options. Let's put it this way.
Right. So TD Bank takes fourth place. Of course, there's the anti money laundering story attached to it. But first, what makes it a good investment?
So TD was for a long while my third favorite bank. So of course, not enough to make number one, number two, but definitely a very strong company. So what I liked about it was the fact that 1/3 of its business was in the US. So yes, it was a little bit more like CIBC, a classic banking model, but with great exposure to the US where there was a lot of growth potential over there. It is like first, second bank in terms of assets, depending on the moment that you look at. They're pretty much at the same level of Royal Bank. So a big bank, wide network in Canada, and having a very good way to develop business in the US, which eventually hurt them with the money laundering story. But beside
Mhm.
before that, it was a very, very strong bank.
And is the impact of the investigation a real risk at this point or a buying opportunity? And what are its other downsides?
So it's been a while now that we know the result of that investigation. So, good news, I could say, is everything has been priced in. Like, we know that the company is not able to grow its asset base in the US. We don't know when it's going to end. Probably not tomorrow. So, don't hold your breath for that. That's also the main reason why it dropped from the third position in my ranking to the fourth. It's more about growth potential at this point. But TD is not a bad investment either. I see it right now. Worst comes to worst, could be a Deluxe bond, but it could find other ways to grow. One example, and I found that interesting in the latest quarter because the numbers were relatively good, all things considered. And TD started to recycle its assets in the US. So, what does that mean is that they started selling some of their business activities or assets to buy new ones. So, they're capped, but they could actually sell, like for example, they sell their stake in Charles Schwab's at a very good profit, and then they can use that money to invest elsewhere. So it's a good way to meet the new rules in place due to the money laundering investigation impact, but at the same time to find some growth. There's definitely growth opportunities in Canada as well. So overall, probably not a bad investment, but again, there are better choices.
Okay, so now we are starting to talk serious business here.
The
Bank
big
of
three.
Montreal. Yeah, big three. Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. So Bank of Montreal BMO is at number 3. What makes it reach this top?
Actually, it's kind of ironic, but it's not really BMO that gained a position more than TD losing one. I would put it that
Right.
way. I usually put Bank of Montreal as my fourth favorite. Now it's become my third favorite because they have less problems. They are the fourth Canadian banks in terms of assets, and they have about 60% of their revenue coming from Canada and 30% from the US. It is a more aggressive bank in its business model. They focus more on capital markets, investments, like they created like a lot of ETFs, for example. And one fun fact is it was probably the first or one of the first Canadian bank to open a private wealth service. So they bought Aris Bank, that was a private bank in Chicago a while ago. It's probably like, I don't know, like 20 years ago or something like that, and started to do like private banking, having a specific service for clients with a high net worth. So we're talking about more than $1 million today. I think it's even to deal with Harris Bank, I think you need like 5 million now. But anyways, like just very high end type of service, top notch. Of
Right.
course, making a lot of money because like this business model is all about charging a fee on the investment. And when your
Mhm.
client starts at like 1 or 5 million, well, you're making a lot of fees.
But then, why is it not the number 1 bank?
Well, aggressive model means two things: a lot of growth potential and a lot of volatility. So that's one thing. From one quarter to another, their capital market segment could save the day or kill the day. Recently, it's actually what happened on the good side is while provision for credit losses for their classic banking activities has been on the rise for the past 12 months, the latest quarters show very strong wealth and wealth management numbers and capital markets, which have saved BMO from a bad quarter, transform it into like a lot of growth in there in terms of revenue and profit. The acquisition of Bank of the West has highlighted a little bit more execution risks, created a lot of like messy PCLs. Again, that was also at the center of this tougher transition and integration than expected. That's the main problems with this one. Again, not a big thing. We're now in the top 3, so not a bad investment.
Mhm.
But there are 2 other banks that I prefer, believe it or not.
So you probably have guessed it by now, listeners. It's either Royal Bank or National Bank, and some of you may also know Mike's love for National Bank. Well, maybe you didn't see this coming, but NA is at position number 2 this year. Explain all this to us, Mike.
Yeah, big shocker. I mean, to be fair, National Bank is one of my largest holdings. It's still number 1 in my heart, but let's not get emotional here. I have to throw out my pillow of National Bank. Cannot sleep with it anymore. No, that's a joke. I don't have a pillow. Okay, come on, guys. Let's go. Be serious here. Okay, so the problem here is we are facing so much uncertainties. We just did an episode about how to Trump proof and Trump proof and tariff proof your portfolio. National Bank is still the sixth, like the smallest of the big
Mhm.
six. A lot of exposure to Quebec, particularly like 50% of their revenue are still based in La Belle Province, which I mean, it's interesting because like Ontario and Quebec have like a wide diversification for their economic activities, but I always mention it's not good to be heavily concentrated into one province or one state. And that is good for all kind of businesses. Well, it has to be also be true for National Bank. If we get into a recession, it's going to be tougher for National Bank versus Royal Bank to get out of it. So that's the only reason. It's more kind of like a temporary reason, I would put it that way. And to make the show a bit more interesting, because I mean, I'm not going to sell my shares of National Bank to buy more of Royal Bank, but to be fully transparent, I own shares of both.
So, Mike, what still makes it a strong investment and one that you will keep?
It's still 2 out of 6. It's pretty good, right? What I love about National Bank, it is really growth oriented. They can count on multiple business segments to fuel that growth. We're talking about wealth management, including private banking 1859, like where I used to work. That department keeps on growing. The acquisition of Canadian Western Bank is actually a very smart move. Yes, they expand their business in Western Canada. They have a strong base over there, but that was not really like I think the best move out of that. The best move to get Canadian Western Bank was first to get a bunch of commercial loans, because with a bunch of commercial loans, you have a bunch of entrepreneurs. And a bunch of entrepreneurs, when they sell their business, well, they will get into the wealth management part. So that is one of the major reasons why they made that acquisition, creates a huge pipeline for years to come. The second reason that is as much as good, if it's not better, they get their hands onto a lot of deposits. And the most important thing for a bank that wants to do a lot of capital markets activities is they need a lot of capital, because they need to respect some ratios that are super important. And making their hands on Canadian Western Bank deposit was a very strong move for them. More access to capital makes it that the capital market segment can do more deals, create more value, and keeps on growing. Finally, they have an interesting US and international business segment with Credigy that is based in the US, a specialty credit firm, and the full control of ABA Bank, a big bank in a small country. So similar business to National Bank, but in Cambodia. So ABA Bank is also showing some great results. So as you can see, I'm still in love with National Bank. My first and only employer, actually, because when I quit the bank, I started working for myself. But yeah, so definitely I'm going to keep this one. And I mean, to be fair, it still outperformed all other banks over the past 5, 10, and 15 years. So there must be doing something good.
But now, why is Royal Bank RBC the best Canadian bank, at least in 2025?
Yeah, so Royal Bank, when we're gonna do our ranking next year, we might as like just change Royal Bank and National Bank. But the thing about both banks, what I love the most is their diversification. For Royal Bank, it's similar to National, but it's just like So much bigger. They do have about half of their business related to personal and commercial banking. The other half is driven by wealth management, capital markets, and insurance. So I love the fact that they can count on, yes, they're going to lend money, they're going to do classic banking activities, but they also have a huge part of the pie related to capital markets and wealth management. And those are probably like growth drivers for banks. They have shown stability in their results. Their dividend triangle is incredibly solid, similar to National Bank. But again, if you're able to replicate same growth for revenue, earnings, and dividend, but being like, I don't even like, maybe it's like they're like what, like 5 or 10 times bigger than National Bank. It's just like great business, really well run.
But which downsides should investors know about Royal Bank?
Well, one thing I don't really like is the fact that 60% of their loan book is mortgages. So, a huge exposure to the housing market and the Canadian economy. So, of course, if we run into a recession in Canada, there's no place to hide in terms of banks. The big six are going to get hurt. So, Royal Bank will not be different at this point.
So, Mike, which bank should investors hold? And are banks still the best Canadian investment in the financial sector?
Like, no matter if you agree with my ranking or not, that's not the point. It's just to highlight differences. I would always favor to go for your favorite two. So identify the business model you love the most, look at the financial metrics because you'll see a
Mhm.
great discrepancy between one and the other. And then it just helps you not having to monitor all of those. Because you know what? Again, Scotiabank paused their dividend increase. That's a passive dividend cut. And if you don't believe me, well, I'm pretty sure, Vero, that if I tell you that I'm not going to raise your salary this year, you're not going to say that I'm not the best employer anymore. You're probably going to find somebody else that has like better
Maybe
salary
not,
policies.
maybe not after a year, but after a couple of them for sure.
So there you go. I mean, it's the same way for investors, right?
Mhm.
So it is a better way to go for the favorite two. Makes it a lot more easier and straightforward. Now, is investing in Canadian banks the best idea in the financial sector? Well, there are a lot of other opportunities. And this is another reason why, like having five banks and then you're missing out on all the other opportunities, which would not make sense. And on the other side, if you're trying to invest in all those opportunities, you're going to end up with like 12 stocks in your portfolio
Right.
in one sector. Maybe not the best thing. First, you do have like smaller banks such as EQ Bank that is like very active, growing very fast, having pretty good customer service, online banking as well. So very interesting one. You have Go Easy that specialize into more specialty credit. So charging a little bit more for furniture loans, car loans, stuff like that. So doing again very well, increasing their dividend like crazy. And you have Propel Holdings as well. Propel, which is interesting, is that they're using AI. So they save like they're making a lot of more money to underwrite their loans. And
Hmm.
you may be thinking, oh my God, like they're a good part of their growth is related to AI. But it's actually quite smart because when you are a credit officer, what is the most important thing is that you follow rules and whatever best than AI just being told to follow those rules. So as long as you have a very strong underwriting process, you can train your AI to do it. So that's,
Right.
I mean, it's a small cap, bunch of risk there. Be careful, but I just wanted
Mhm.
to kind of like highlight another company that we don't talk enough. Then you have asset manager like Brookfield that is often discussed on the show. You have TMX Group, ticker X.to, that runs the Toronto Stock Exchange. Amazing dividend triangle. Very interesting type of business model as well. We have discussed stock exchange in the past on the show, so you can go back on the Dividend Guy blog and you're going to see that episode. But basically, they're making money regardless of what's happening on the market. As long as people are selling or buying, they're selling
Mhm.
their data as well. So a lot of recurring revenue. So definitely a great place to start if you're looking to buy in the financial sector, but you're tired of banks. I have to mention life insurance companies, Great West Life, Manulife, Sun Life, Power Corporation, a whole different world, not necessarily tied to banking activities, but they do have big wealth management, asset management segment, about like 25 to 30% of their revenue for most of those. You have Intact Financial as well for personal and commercial insurance. So, see, like the list is very long. So, why would you limit yourself to five banks? Take two, that's fair. But after that, there's plenty of other opportunities in the financial sector that will actually help having a more balanced and more diversified portfolio and grab other great growth opportunities out there.
Well, thanks a lot, Mike, for sharing your Canadian banks ranking. Listeners, again, you should not try to hold all banks like you'd collect Pokemon cards. Instead, focus on the best assets in each industry. To quickly identify thriving businesses in their sectors, download our Dividend Rockstar list at thedividendguyblog.com/rockstar. For the show notes and related content, including Mike's recently earnings review of all the banks with EQ Bank and GoEasy, visit thedividendguyblog.com/223. If you like what we do, hit the subscribe button underneath our podcast logo and leave us a 5-star rating. Until next week, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.